We've come a long way together. From the very first steps of understanding the basics of finance to celebrating those significant milestones, it's been quite a journey. Each step has brought us closer to financial freedom and stability.
Remember those early days? When we were just starting out, learning the ropes of budgeting and managing our expenses? It was a time of discovery and sometimes a bit of trial and error. But those lessons were invaluable.
Learning about financial wellness was a game changer. We attended seminars, read books, and absorbed as much knowledge as we could. This foundation set the stage for making informed decisions and building a secure financial future.
Creating a budget that works for us was crucial. We meticulously planned our expenses, tracked our spending, and adjusted our budget as needed. This discipline helped us stay on track and achieve our financial goals.
You built an emergency fund for those unexpected bumps in the road. This safety net provided peace of mind, knowing that we were prepared for any financial surprises that came our way.
You even tackled debt and boosted that credit score. Paying off those credit card balances and seeing that credit score rise was a huge accomplishment. It opened doors to better financial opportunities and lower interest rates.
Saving for short-term goals became your mantra. Whether it was for a vacation, a new gadget, or an emergency fund, setting aside money regularly made those dreams achievable.
You're a pro at making your money work for you. Investing wisely, reviewing your portfolio, and using financial apps to track your progress have all become second nature.
Now it's time to shift gears. With a solid financial foundation, we can explore new opportunities and take calculated risks. Time to explore the exciting world of investing. From stocks and bonds to real estate and mutual funds, the possibilities are endless. Get ready to watch your money grow. With the right strategies and a bit of patience, your investments can yield significant returns. The future is bright, and your financial journey is just getting started. Think of investment vehicles as your financial chariots. Each one is designed to take you towards wealth accumulation, but they take different routes, travel at different speeds, and offer different levels of comfort. Choosing the right vehicle, or a combination, depends on your financial destination and risk tolerance.
Imagine owning a tiny piece of your favorite company. That's what stocks are. When you buy a stock, you're purchasing a small part of that company. This means you have a stake in its success and growth. You become a shareholder, a part owner. This gives you certain rights, like voting on important company decisions and receiving annual reports. As the company grows, so does the value of your stock. If the company performs well, the stock price increases, and your investment becomes more valuable. This can lead to significant financial gains over time. You might even receive dividends, a share of the company's profits. Dividends are typically paid out quarterly and can provide a steady income stream in addition to the potential for stock price appreciation.
The potential for high returns is one of the main attractions of investing in stocks. Historically, the stock market has provided higher returns compared to other investment options like bonds or savings accounts. It's also easy to buy and sell stocks. With the advent of online trading platforms, you can trade stocks from the comfort of your home using a computer or smartphone. However, it's important to remember that values can fluctuate. Risk of losing money. The stock market can be volatile, and stock prices can go up and down quickly. This means there's always a risk of losing some or all of your investment. To get started, open a brokerage account. Research companies thoroughly before investing. Start small and gradually increase your investment as you become more comfortable with the process. Diversify your portfolio to spread risk and maximize potential returns.
Think of bonds as IOUs. You lend money to a company or the government. They promise to pay you back with interest. Bonds are generally considered less risky than stocks.
Regular income from interest payments, less volatile than stocks, lower potential returns than stocks. Interest rates can affect bond values. Research bond issuers. Consider bond funds for diversification. Mutual funds pool money from many investors to buy a basket of stocks, bonds, or other assets. This pooling of resources allows individual investors to access a diversified portfolio that they might not be able to afford on their own. By spreading investments across various asset classes, mutual funds aim to reduce the risk associated with investing in a single security. This way, even if one investment performs poorly, the impact on the overall portfolio is minimized. It's like having a professional chef create a delicious meal with various ingredients. Just as a chef carefully selects and combines ingredients to create a balanced and flavorful dish, a portfolio manager selects a mix of investments to create a balanced and potentially profitable portfolio. The expertise of the portfolio manager ensures that the investments are well researched and strategically chosen to meet the fund's objectives.
Diversification helps reduce risk. By spreading investments across different asset classes, sectors, and geographies, mutual funds can mitigate the impact of market volatility. This means that if one sector or region underperforms, the losses can be offset by gains in another area. Diversification is a key principle in investing because it helps protect your portfolio from significant losses and provides more stable returns over time.
The pros? Instant diversification, and they're managed by professionals. This means you don't have to spend time researching and selecting individual investments. Instead, you can rely on the expertise of professional portfolio managers who have the knowledge and experience to make informed investment decisions. Additionally, mutual funds offer liquidity, meaning you can easily buy or sell shares without significant delays or costs.
But, the cons. Fees can eat into returns and performance can vary. Mutual funds charge management fees and other expenses, which can reduce your overall returns. It's important to understand these costs and how they impact your investment. Additionally, not all mutual funds perform equally well. Some may underperform their benchmarks or peers, so it's crucial to choose funds with a strong track record and align with your investment goals.
So how do you get started? First, determine your investment goals and risk tolerance. Are you looking for long-term growth, income, or a combination of both? Understanding your financial objectives will help you choose the right type of mutual fund. Assess your risk tolerance by considering how much volatility you can handle in your investments. This will guide you in selecting funds that match your comfort level with risk.
Then, choose a fund that aligns with your needs. Research different mutual funds, compare their performance, fees, and investment strategies. Look for funds that have a consistent track record and are managed by reputable firms. You can also seek advice from a financial advisor to help you make an informed decision. Once you've selected a fund, you can start investing by purchasing shares through a brokerage account or directly from the fund company. Regularly review your investments to ensure they continue to meet your goals and make adjustments as needed. ETFs are like mutual funds, but they trade on stock exchanges like individual stocks. This provides more flexibility and transparency. You can buy and sell ETFs throughout the trading day.
Low fees, diversification, trading flexibility.
May require more research. Trading costs can add up.
Understand how ETFs work. Choose an ETF that matches your investment strategy. Taking the first step. Your investment journey begins. Investing can seem daunting at first, but remember, you don't need to be a financial expert to get started. Start small. Learn as you go. The most important step is to simply begin.
Open a brokerage account. Explore online resources. Consider seeking advice from a financial advisor. Your financial future is worth it.
Risks and rewards. Navigating the investment landscape. Investment always involves some degree of risk. It's important to understand that the value of your investments can go down as well as up.
Diversification is key. Don't put all your eggs in one basket. Invest for the long term. Ride out the market fluctuations. Patience is a virtue, especially in investing.
The power of informed investing, shaping your financial future. Every dollar you invest is a seed you plant for your future.
Informed investing empowers you to take control of your finances, grow your wealth, and achieve your financial dreams.
Start today and watch your financial garden flourish.